Yeah, I think so.
Yeah, is it saying recording?
Yeah.
Huh?
Yeah, I think so. Yeah.
Is it yeah. Okay, now let's discuss for just a few minutes. I saw or noticed a number, some confusion on the midterm about freedoms. People somehow associated freedom with democracy, and that's true and not really true. First of all, the big confusion about an economy is they just think, oh, if you got freedom, then the economy is doing well. You got fundamentally two completely different types of freedoms. One is called political freedoms. And the other one is called economic freedoms. And many people confuse political freedoms with economic freedoms and kind of like meld them into one, and you cannot. You have to clearly differentiate between the two. And here is the key. For economic performance, the most important is economic freedoms. We have maybe about 5 or 6 people who very correctly notice that you may not have any political freedoms, but you may have a lot of economic freedoms. And the economy will perform very well. I already gave in the lectures examples. Let me try to repeat it again. A country with relatively low political freedoms is Singapore, but very high on economic freedoms and very, very high economic performance. The other country will be Hong Kong. Another country which is a totalitarian regime, but surprisingly has a lot of economic freedoms and has an outstanding global economic performance, is Dubai. So Dubai is economically free. All right? So you may have a lot of economic freedoms with practically little or no political freedoms, or you can have a totalitarian regime. Now, notice that the opposite may be true. You may have countries with a lot of political freedoms, but relatively few economic freedoms, where the government intervenes in a lot of different places. So you may have elections, you have the democratically elected president and government, and at the same time, economic freedoms are very few. You have a lot of bureaucracy, you got a lot of administration. A good example comes to mind will be India. Well, India got other social problems and social freedoms, but you need to understand that a country may have a lot of political freedoms and relatively few economic freedoms, or it could be the opposite. Now, the example in Europe, which is very politically free and economically relatively unfree, will be France. France, the government intervenes everywhere, they regulate everything, they want to intervene in all sorts of things. So the government is highly interventionist in the economy, but France is, we all admit, fairly politically free, with elections and all the other things. The democratic process more or less works, okay? Now, here's another thing so that's number one. For economic performance, for the economy, what's important is economic performance. Second one is that, let me see how to do this. Democracy, for some reason, many people associate or equate with freedom. Totally untrue. Totally untrue. You have many, many countries in the world that have somewhat like a democracy, where they have elections, where the elections are relatively honest, okay, they're not cheating and fake or all the other things, and at the same time, people don't have a lot of freedoms. Example, let's try and see. Iran will be one example where, yeah, you got elections, you got everything going on, but somehow political freedoms are not very high. It's low on political freedoms, and somehow it is low on economic freedoms. Another example will be Venezuela. Again, you would have elections. They will not be fudged or forced or any other problems. People will select the person. He will be, to an extent, representative. But nevertheless, in Venezuela, you don't have a lot of especially economic freedoms, and political freedoms are a little bit shaky. So, when you talk about democracy, you can even say that most of Latin America would have a lot of democracy or democratic process, but it will not have especially a lot of economic freedoms. Well, let me provide you the best example I'm familiar with, because I've lived through and with it. That's my home country, Bulgaria. Somehow we are highly democratic. We pretend to be as free as it is, or well, we dream to be. But economically, the government chokes the economy. Yeah, and that's why we love the EU, because the EU gets a big hammer and hammers on our politicians to relax rules, to relax regulations, to increase our economic freedoms, okay? Because the economy was historically unfree. Again, most communist, meaning former socialist countries, were historically, the economies were highly regulated, and the economy was highly unfree, okay? Controlled, command type economy. And as we transition to democracy, we have somewhat of a decent democracy, but we don't have decent economic freedoms. So you have to be very careful not to make these mistakes to associate democracy. Yeah, that may be true in most of advanced Western Europe, but it's certainly not true for most of the world. Okay? Now, the other thing which, again, it's a little bit tricky and controversial, depends on how you measure, is you have what's called totalitarian countries. Well, in terms of a number, most countries in the world are totalitarian and relatively unfree. Just take a 30-something number, 30-odd numbers of countries in Africa. Right there, you got 30 or 40 countries in Africa, and they're mostly totalitarian, okay? They're not really actually free. You take most of the Arab world, the countries are mostly, for the most part, totalitarian, not quite free. So once you start looking deeper and deeper, you'll see that many economies are not really free. Now, the other thing which I began on the very first lecture and tried to explain was that when we talk about advanced and developed countries, there are barely 25 countries in the world. You have barely 16 or 17 or 18 European economies and countries. You got the US, you got Canada, you got Australia, you got 4 or 5 Asian tigers, Japan, and Australia. That's it. These are all the developed countries in the world, not much more. So you have to understand that being a developed country in the world is an exception, not the rule. The exception is you need this, you need this, you need this, you need this, means you need economic freedoms, you need functional and operational judicial system, you need a lot of things. You need a good education, of course you need a good healthcare system, you need a very good infrastructure. In other words, you need a whole bunch of things, and you can check all of them, then you can get to become an advanced economy. And let's say, I don't know, depends on how you count the countries, whether it's 150 countries around the world or 200 countries around the world, doesn't matter. 10% are relatively rich, let's say 15%, and 85% are developing and relatively poor, and that's part of the reality. And now, the number of developed countries or the number of poor countries will increase as we add to them Portugal, which is going to be remarkably poor at the end of this crisis, Greece, which is practically on the verge of poverty, Italy is going to be very impoverished, Ireland is going to be impoverished or poor, Spain has big. So you're going to add a whole bunch of other supposedly developed economies into the ranks of the poor. So you're going to have the developed poor, okay? That's another piece. And I had a third one, but I don't remember anymore. So let's see, any questions here about these comments or clarifications? Yeah?
Can you tell us, is this what we should have written at the exam, or what did you wanted to hear at the exam?
Oh, no. Many people got this right on the question. I just am clarifying how some people make the shortcut that most democracies are relatively free, which is not true. Okay, so they make this. So some people make this quick connection, which connection is fundamentally false, and some people confused political freedoms with economic freedoms. Now, for the first question, the average is about 5 out of 6, so it's close to A. For the second is over 4.5 out of 6, so they all verge around, 75–85%. So they all verge around A, a little bit over, a little bit less. That's a whole different story. I'm just trying to clarify because these are, especially, you need to make this extremely important distinction between political and economic freedoms. Okay, now today we get to a topic with which I'm way more familiar with. I could easily make 1 month or 1 semester on it. Unfortunately, we got only 1 week. It's a topic of global capital markets. Global For this, you really need a political science expert, and political science professors can do a way better job. But I got some ideas. Now, here, global capital markets will be. What's the question? The question?
Which chapter is that?
Chapter 11.
We skip 9 and 10?
Sorry?
Do we skip 9 and 10?
Yeah, we skip 9 and 10. That will be easy for me and hard for you.
Yeah.
Because I've been teaching this for 10 years. All right, so introduction. All right, very simple. Over the last 20, 30, 40 years, global capital markets have been steadily growing. They've been growing faster. They've been growing the fastest. They've been growing even faster than foreign direct investments. In other words, we have had an explosive growth in global capital markets. Let's see. Reasons were, so you have here, section number 1 is introduction. And within the introduction, the key one is explosive growth. Explosive or exponential, whichever you like. So, exponential growth is based, of course, on overall reduction of capital controls. Capital controls, and I'll explain a little later and spend more time on what is capital controls, and the other one is financial deregulation. So, most governments around the world have heavily deregulated. Some deregulation in the US, a lot of deregulation in the United Kingdom. Later on, deregulation came in the rest of the Europe. Big one was in Germany. Later on, the push to deregulation was in Hong Kong. Later on in Singapore. For a while, relatively, not too much, relatively deregulated was the Japanese markets. So governments around the world were in a race to deregulate in order to attract capital. Somehow, capital hates regulation, and regulation push away capital. And deregulation somehow attracts capital. That's why London has been for a long time the financial capital of the world, and that's why as it lost its global financial leadership after World War II, in order to New York, in order to regain back, they understood that their only way forward was major financial deregulation, which they did in, I'm going to discuss a little later. Okay. So that's number one. Number two is financial interconnectedness, or financial, well, let's leave it like that, interdependence. This simply means that one country's economy is heavily dependent on the capital and the capital flow of another country. This are learning the Greeks today the hard way, that they become extremely dependent on German and Austrian capital flows. Okay, the US has become extremely dependent on Chinese, Japanese capital, and a little bit of the Arab and Russian capital. Okay, so you have huge interconnectedness and interdependence, and if one country falls, it just brings all of them as a domino. This financial interdependence has as a consequence, red color, financial contagion. Contagion is, for you guys, someone may translate, is a transfer of disease from one person to another person. So, one person is sick, makes his sickness makes another person sick. Anyone? Dictionary in German? Contagion? So, financial contagion means that when one country gets sick, it transferred the sickness to another country. So financial contagion means that during the Asian crisis in 1997, the crisis began in Thailand, right in here in Thailand, and soon after that, within a matter of months, the crisis transferred to a second country, and then to a third country. In other words, capital, when capital gets scared, it gets scared en masse, and when they start running away, they start running away from all similar countries. This financial contagion you should have easily observed very clearly in Europe. In Europe, the financial crisis, the global financial crisis, let's call it the European financial crisis, struck first in country in
United States.
well, within Europe. Struck first hard in Iceland, and the Iceland economy fell apart. As soon as Iceland economy fell apart, it was just a matter of days before, which was the next economy that collapsed? Ireland, and the Irish economy collapsed. And then collapsed the Portuguese economy. And after the Portuguese economy collapsed, the Greek economy. And then it became clear to anyone with a little brain, this means to any politician, that the next fall is Spain, Italy, and down the road, France. So this is what financial contagion means, and financial contagion simply means that you have what's called a domino effect. Domino. Domino effect means one country falls, the next country falls, the next country falls. All right, let's talk about question again. Question? What's the question?
Frankreich. I know it already. I was just the dominoes of the countries.
Yes, domino effect means that when one country falls, it pushes the next country. And the next country falls, it pushes the next country. And when the next country falls, pushes the next country. So they start falling like dominoes, one after another. And there is no stopping them. So that's the domino effect. Now, example. Example today, meaning for the last 2 or 3 months while you've been partying here in Thailand on the beach, there's been a major contagion effect, and a big crisis is brewing in, I was telling you maybe a while ago, in Indonesia. Indonesia, they call it Indonesia. In Indonesia, they got a big crisis going on. The banking system is steadily freezing relatively fast. Interest rates are skyrocketing. Lending is almost disappearing. The government is choking. Businesses are choking. And it's only a matter of time before the whole economy collapses, unless the IMF goes and lends them a helping hand together with the World Bank. And you know exactly how it works. You did it already once, they've done it once, they'll try, meaning the IMF and the World Bank will try to do it again. Okay? Now, a similar country that's going on and choking the economy is in terrible shape, it's a complete disaster, is India. You probably don't read about it, but since June, things in India are going very bad, very fast, okay? So again, it's not a matter of weeks, but it's a matter of months. And now people are beginning to suspect that you are getting slowly financial contagion in Asia. Maybe the starting point will be Indonesia, and one by one, some of the weaker Southeast Asian economies will be falling. Now, again, all of these things started with the Federal Reserve saying that they may withdraw some liquidity, what they call tapering. In other words, the rate of printing of $85 billion a month, they can reduce a little bit, and capital got scared away because what they did was they borrowed the money in the US and lent it out to Indonesia and the rest of Asia, and now they say, oh, there won't be enough money in the West, meaning liquidity will dry up, we got to pay back, we better sell now in Indonesia and pay back before things get real hard. So the expectation or the anticipation of withdrawal of liquidity in the US turned out that the result was a collapse in Indonesian economy again. Okay, so it is all the interconnectedness, and it's all driven by the global capital markets. Let's see what else I got here. Financial contagion, not much more. Section number 2. And section number 2 should be, I guess, benefits. So, what are the benefits? And the benefit, first we go and discuss generic or any capital market. So we got a short discussion, an introduction for you. Not many of you have studied financial economics or finance to understand these things. So I'm going to provide a 10-minute introduction of what is a capital market. And a capital market is a market where capital is traded. So this is the market for bonds primarily, and stocks, and a whole bunch of other things we call, with the general financial term, financial resources. Financial resources is the nice and sweet way of saying capital. Okay. So financial resources, you have two types. One is called investors. And investors have surplus or excess of financial resources. So investors have surplus. They got more financial resources than they need, and they use these to invest. They invest by buying stocks, by buying bonds, or by making deposits. Okay? So investors got a surplus, and the other one, let's see what they have. They call them, but it's not correct, borrowers. Borrowers have a shortage or deficit. Surplus, deficit of funds. These are people who have less funds than they actually need. Okay? And we're going to add another one, which is businesses, borrowers, and now let's clarify. Borrowers are only those businesses that use bonds and loans. In other words, borrowers are associated with debt. Borrowers are associated with debt. Okay? So, sometimes all of this distinction, let me clarify again, I'm introducing a lot of financial information called debt capital, and the other one is called equity capital. Debt capital is associated with bonds and loans. We call these fixed income. And equity capital is associated with stocks and stock ownership. Okay? So, financial resources, you got investors and you got borrowers. Businesses would be both borrowing capital on the debt market, and we call this, the general term in English is to raise capital. To raise capital means to attract financial resources or to attract capital by issuing debt or by issuing equity, by issuing stocks or by issuing bonds, okay? Or loans. So we say you raise capital. And you have businesses which specialize in this type of business. We call these financial intermediaries. and I typically teach a whole course on these financial intermediaries in a university. Example will be banks, financial intermediary, insurance companies will be financial intermediaries, brokers will be financial intermediaries, other type of lenders, mutual funds, pension funds, all of these, and financial intermediaries, sometimes we call them financial institutions. Banks are the main one, but pension funds, mutual funds, insurance companies will be all the others. So these are the businesses which specialize in intermediating financial resources. These are the institutions that stay between investors, those with surplus of funds, and those with shortage of funds, okay? And that's the little chapter, no, sorry, the little picture over here on page 413. Let's see your zooming capabilities, if you can zoom in here. I mean, the picture is not very good and correct because they just call them borrowers, but they also have equity, also have stocks, and a few other things.
The picture.
Yeah? Zoom in nice? Look good? Done?
Yeah.
Okay. So, commercial banks. Banks go by commercial banks and investment banks, okay? Commercial banks specialize in the business of deposits and loans, and investment banks specialize in the business of raising capital by issuing stocks and bonds. We call these securities, okay? So let's see what else is a good introduction. Okay, equity loan, debt loan, corporate loans, okay? And, well, that's it. Let's take a 5 or 10 minute break and then we continue from here.